If you have ever placed your hard-earned money into a company, trusting the numbers that were carefully laid out in front of you, only to later discover that those numbers were designed to mislead you, then what you are about to hear is among the most important things you will ever come across as an investor. This is not simply a story about bad companies or dishonest executives. This is a deep, carefully researched exploration of how companies across the world, large and small, use accounting techniques to make themselves appear far more profitable, far more stable, and far more impressive than they truly are. And the frightening reality is that many of these techniques are not even technically against the law. They live in the gray zones of accounting rules, tucked away in the corners of financial statements that most investors never bother to look at closely. Howard Schilit spent decades studying financial statements and looking for the hidden signals that separate honest companies from those that play games with their numbers. What he found changed the way many professional investors and financial analysts look at corporate reporting forever. He discovered that companies which eventually collapse or disappoint investors almost always show early warning signs in their financial statements long before the collapse actually happens. The signs are there, waiting to be found. But most people simply do not know what to look for. That is exactly what this journey is about. We are going to walk through the world of financial shenanigans, one layer at a time, and by the time we reach the end, you will have a sharper and more disciplined eye than the majority of people investing alongside you in the markets right now. Let us begin at the very beginning, because before you can catch a trick, you need to understand the game itself. Every public company is required by law to report its financial results to investors. These reports come in the form of income statements, balance sheets, cash flow statements, and various other disclosures and notes. In theory, these documents are supposed to give investors an honest and accurate picture of how the company is truly performing. In practice, however, management teams have enormous flexibility in how they present these numbers, and where there is flexibility, there is opportunity for manipulation. Financial shenanigans, as Schilit carefully defines them, are actions taken by companies to distort their true financial performance or their true financial condition. These actions are almost always designed to make the company look more profitable, more cash-rich, or more financially solid than the underlying reality actually supports. The goal is almost always to deceive investors, analysts, and creditors into believing that the company is doing far better than the actual evidence would suggest. Now you might be thinking, surely auditors catch these things. Surely the regulators step in and correct the record. And yes, sometimes they do. But the uncomfortable truth is that auditors check whether companies follow accounting rules, not whether management is being genuinely transparent in spirit. Many of the most effective shenanigans are technically within the rules. They are aggressive, misleading, and structured to create a false impression, but they are organized in such a way that allows the company to say, "We followed the guidelines." And by the time anyone actually catches on, executives have already cashed out their stock options and moved comfortably onto other ventures. This is precisely why the responsibility falls on investors themselves to develop the skills necessary to detect these tricks. You cannot rely entirely on auditors. You cannot rely entirely on analysts, many of whom operate under their own significant conflicts of interest. You need to understand the game for yourself, because the market will not protect you if you do not. So let us get into it properly. Schilit organizes his discoveries and insights into three broad categories of shenanigans. The first category covers earnings manipulation, where companies play games with the income statement to make profits appear larger or losses appear smaller than they truly are. The second category covers cash flow shenanigans, where companies distort the cash flow statement to hide the fact that the business is not actually generating the real cash that investors believe it is. The third category covers key metrics shenanigans, where companies use non-standard, self-invented measurements to distract investors away from poor performance that would be visible in the standard financial statements. Each of these categories contains multiple specific techniques, and each technique carries its own set of warning signs. Let us go through them carefully and thoroughly, because the more deeply you understand each one, the better equipped you will be to protect everything you have worked hard to build. We begin with earnings manipulation, and specifically with the most common and most dangerous technique of all, recording revenue too soon. Revenue is the lifeblood of any business. It is the money that flows in from selling products or services. Investors watch revenue closely because growing revenue usually signals a growing business. And because of this intense attention on revenue figures, companies have every incentive to make their revenue numbers look as strong as possible, even when the underlying reality is considerably less impressive. One of the most widespread ways companies inflate their revenue is by recording it earlier than they genuinely should. Under proper accounting principles, a company should only record revenue when it has truly earned it, meaning when the product has been delivered or the service has been performed, and when payment is either received or is reasonably certain to arrive. But companies routinely bend these rules in ways that create a very misleading picture. Consider a software company that signs a large contract with a customer. The contract covers 3 years of service and ongoing technical support. The full payment arrives up front at the beginning of the arrangement. A company following honest accounting principles would spread that revenue recognition across the full 3 years, recording only the portion actually earned in each accounting period. But a company playing accounting games might record the entire amount as revenue in the very first period, making current year profits look enormous, while leaving future years looking hollow and disappointing in comparison. This is called premature revenue recognition, and it is one of the oldest tricks in the entire history of financial deception. The reason it is so dangerous for investors is that it creates a temporary but convincing illusion of growth. The company reports fantastic results this quarter. The stock price rises. Executives exercise their options and sell their shares, and then the following quarter, the numbers look terrible because all that revenue was pulled forward from the future and there is nothing left to report. There are several warning signs that investors should watch for when examining whether a company might be recording revenue too soon. One of the most reliable is a growing and persistent gap between revenue growth and cash flow growth. When revenue appears to be growing strongly, but the actual cash coming into the business is not keeping pace, it often means that the revenue being reported is not yet supported by real cash. The company is counting money it has not actually received yet, and in some cases, may never receive at all. Another important warning sign is a rapid increase in accounts receivable relative to revenue. Accounts receivable is the money that customers owe the company but have not yet actually paid. When this figure grows much faster than revenue over multiple periods, it suggests that the company is booking sales without collecting the corresponding cash. This can happen legitimately when a business is growing rapidly and simply takes time to collect from customers. But it can also happen when a company records a sale that the customer has not genuinely committed to pay, or when the company is shipping products to customers who have not really ordered them in any meaningful sense, a practice known in the industry as channel stuffing. Channel stuffing deserves particular attention because it has been used by dozens of major corporations over the decades to temporarily and artificially inflate their sales numbers. The mechanics of it are straightforward. Near the end of a reporting period, the company applies pressure to its distributors and retailers to accept large shipments of product, even if those distributors do not actually need that inventory at the current time. The company records all of these shipments as recognized revenue. The distributors accept the goods, but often with a quiet understanding that they can return whatever they cannot actually sell. So from the company's perspective, the revenue line looks spectacular. But the underlying reality is that much of those goods will eventually come back, and the recorded revenue will need to be reversed in a later period. The company Sunbeam, under the aggressive leadership of Al Dunlap in the late 1990s, used channel stuffing on a grand and systematic scale to inflate its reported sales figures. It shipped enormous quantities of products, including barbecue grills and other seasonal household items, to retailers long before those retailers actually needed them, often during winter months, for products that would only sell during summer. The retailers went along with this arrangement because they were offered deep discounts and unusually extended payment terms. Sunbeam booked all of these shipments as current period revenue. When the scheme eventually came apart, the company was forced to restate years of financial results and ultimately filed for bankruptcy protection. The Sunbeam case illustrates several important principles with great clarity. The warning signs were visible in the financial statements for any investor who looked carefully and with appropriate skepticism. The manipulation was driven by the enormous pressure on management to deliver the growth that had been enthusiastically promised to investors. And the incentive structures were severely misaligned, with executives rewarded based on short-term reported results rather than on sustainable value creation for the people who actually owned the company. Moving beyond premature revenue recognition, another major earnings manipulation technique involves recording revenue that is completely bogus, meaning revenue that has no legitimate underlying business transaction behind it at all. This is outright fraud in most cases, but it is remarkable how long companies can sustain such schemes before anyone detects what is happening. One classic version of bogus revenue involves transactions with related parties. A company might arrange a deal where it appears to sell something to another entity that it secretly controls, or that is owned by a family member or close business associate of the executive team. The transaction gets recorded as revenue. The cash moves from one pocket to another through carefully constructed legal arrangements, and from the outside, it looks like a perfectly ordinary commercial transaction. But there is no real economic substance behind it. The money is simply going in a circle between entities that are connected to each other in ways investors are not told about. Another version of bogus revenue involves bill and hold arrangements. Under a properly executed bill and hold transaction, a company can legitimately record revenue for goods that have been sold but not yet physically delivered to the customer, provided certain strict conditions are genuinely met. The customer must have sincerely requested the bill and hold arrangement. The goods must be specifically and separately identified as already belonging to that customer, and the goods must be genuinely ready for delivery. But companies sometimes apply the bill and hold label to justify recording revenue for sales that simply do not meet these conditions. Goods sitting in a warehouse, not yet actually sold to anyone in any real sense, get classified as bill and hold transactions and entered onto the books as completed revenue. Enron, the now deeply infamous energy company that collapsed in spectacular fashion in 2001, used a remarkable variety of techniques to manufacture the appearance of revenue and profitability. One of its most creative methods involved the accounting treatment of its energy trading contracts. Enron would record the entire gross value of these contracts as revenue, even though it was acting essentially as a middleman or broker in many of these transactions, and the actual economic value it was genuinely capturing was only a small fraction of the total contract value. By recording gross rather than net revenue across enormous volumes of trading activity, Enron made itself appear to be one of the largest companies in the entire United States by revenue, when in reality, much of what it reported as revenue was simply passing through from one trading counterparty to another without creating any lasting economic value for the company. Now, let us move to the third major earnings manipulation technique, which involves boosting reported income by using one-time gains. This is a particularly deceptive practice because it disguises a non-recurring event as though it were part of the normal, ongoing performance of the business. Every company occasionally sells an asset, receives a financial settlement from a lawsuit, benefits from the reversal of an earlier reserve that turned out not to be needed, or profits from some other non-recurring event that generates a gain. These gains are perfectly legitimate and should be properly reported in the financial statements. The serious problem arises when management uses these gains to offset weak or declining operating performance, making the overall earnings picture appear better than the underlying core business can actually justify. Consider a company whose core operations are genuinely struggling. Its main business lines are losing momentum. Customers are taking their spending elsewhere. Operating costs are increasing in ways management cannot control. Under normal circumstances, this deterioration would appear directly as declining reported earnings. But the company happens to own a piece of commercial real estate that it purchased many years ago and that has appreciated enormously in value over that time. Management decides to sell that property during the current quarter, generating a large one-time gain, which gets added to the income statement and more than cancels out the losses from the struggling core operations. The headline earnings number looks acceptable, perhaps even good. Investors who are not paying careful attention might never notice that the core business is silently deteriorating beneath the surface. The warning sign here is relatively straightforward to identify if you know what to look for. Always examine earnings from continuing core operations separately from total reported earnings that include special items. When there is a significant and recurring gap between these two figures, and especially when management seems to frequently rely on special one-time items to reach their earnings targets quarter after quarter, that pattern is a meaningful red flag. The critical question to ask yourself is whether this company can sustain its reported earnings without the special items. In the cases where this manipulation is occurring, the honest answer is almost always no. There is another version of this technique that involves using asset sales strategically to generate reported gains. A company might sell a piece of manufacturing equipment, a corporate building, a portfolio of intellectual property rights, or even an entire subsidiary, and report the profit on that disposal as income during the current period. This inflates reported earnings in the near term, but also means the company has permanently fewer productive assets with which to generate income in future periods. The one-time gain is essentially consuming future earning capacity in order to make the present look better than it genuinely is. Now, we come to one of the subtler and considerably more difficult to detect earnings manipulation techniques, which involves the timing and classification of expenses. Specifically, companies sometimes shift current period expenses into future accounting periods, making the current period appear more profitable than the economic reality truly warrants. The most common version of this trick involves what accounting professionals call inappropriately capitalizing costs that should properly be expensed in the current period. Let us explain what this means in plain terms that any investor can understand. When a company spends money on something, it faces a fundamental accounting choice about how to treat that spending in the financial statements. It can expense the cost immediately, meaning the full amount reduces reported profits during the current accounting period. Or it can capitalize the cost, meaning it records the spending as an asset on the balance sheet and then gradually reduces profits over future periods by depreciating or amortizing that recorded asset over its estimated useful life. Capitalizing an expenditure is entirely appropriate and correct when the spending genuinely creates a long-lasting asset that will provide economic benefits to the company for many years into the future. Buying a new manufacturing facility, purchasing specialized equipment, or developing proprietary software that will be used for many years are all legitimate candidates for capitalization. But when companies capitalize costs that genuinely should be expensed immediately, because those costs do not create any durable future benefit for the business, they are artificially and misleadingly inflating their current period profits by simply pushing the recognition of that cost into future periods. WorldCom, the telecommunications giant that collapsed in 2002 in what was at the time the largest corporate bankruptcy in American history, engaged in exactly this manipulation on a truly massive and systematic scale. WorldCom had enormous line costs, which were the fees it paid to other telecommunications networks for the right to carry its traffic over their infrastructure. These are completely ordinary recurring operating costs, conceptually similar to rent or wages, and accounting rules clearly required them to be expensed during the period in which they were incurred. Instead, WorldCom's management made the extraordinary decision to capitalize these costs, treating them as if they were long-term capital investments that would generate value for many years into the future. Over several years of sustained manipulation, WorldCom capitalized billions of dollars of these line costs, which caused its reported profit margins to appear dramatically better than they actually were. When the fraud was eventually uncovered, the company had to restate multiple years of financial results. The resulting bankruptcy wiped out billions of dollars of wealth that ordinary investors had trusted the company to protect. The lesson for investors is clear and practical. Pay careful attention to capital expenditure levels relative to what a company is spending on normal day-to-day operations. When a company's capital spending appears unusually high in comparison to its industry peers, and especially when the company is capitalizing costs in categories where all of its competitors choose to expense those same types of costs, that divergence is worth investigating very thoroughly before making or maintaining any investment in that company. Another version of shifting expenses to a future period involves the deliberate manipulation of accounting reserves. Companies routinely set aside reserves for various categories of anticipated future costs, including things like warranty claims on products sold, expected product returns, potential bad debts from customers who may not pay, and other similar contingent liabilities. Establishing these reserves reduces current period reported profits because the company is acknowledging a probable future cost today. But if a company consistently underestimates its reserves, it is systematically and deceptively deferring the recognition of those future costs to later periods. Current profits look better than they should, while future periods are forced to absorb the impact. The timing and magnitude of reserve recognition gives management teams significant flexibility in how they present results. A company can legally adjust its reserve estimates within a fairly wide range of reasonable values, and auditors generally accept these adjustments as long as they are not obviously and egregiously unreasonable. But management can systematically and persistently bias these estimates in whichever direction makes the current reporting period look best, and it is genuinely very difficult for outside observers to identify when this subtle form of manipulation is occurring. What investors should watch for as a practical matter is when a company seems to consistently beat analyst consensus earnings estimates by very small and suspiciously precise amounts, period after period after period, with remarkable regularity. This pattern can sometimes indicate that management is using reserve adjustments to fine-tune the reported earnings number and consistently land just above the published consensus target. Real businesses are inherently messy and unpredictable. Earnings results that are suspiciously smooth and consistently just barely above market expectations deserve serious scrutiny and deserve more investigation than most investors typically apply to them. Let us now discuss another significant earnings manipulation approach: the deliberate concealment of expenses or losses through creative and deliberately opaque accounting structures. Companies have developed a wide and creative range of methods for making costs effectively disappear from the income statement, at least for a period of time. One of the most commonly employed methods in this category involves what are known as off-balance sheet arrangements. In this technique, a company creates a separate legal entity, often structured as a partnership, a trust, or what accounting professionals call a special purpose vehicle, and then transfers certain assets, liabilities, or ongoing business activities to that entity. Because the entity is structured in a specific and carefully engineered way, accounting rules may not require the company to include that entity in its main consolidated financial statements. The expenses, debts, or losses associated with the separate entity therefore become essentially invisible to any investor examining only the primary financial statements. Enron was the undisputed master of off-balance sheet manipulation during its years of fraudulent operations. It created hundreds of special-purpose entities that it used to hide accumulating debt, absorb growing losses from failed investments, and simultaneously inflate reported profits that flowed back to the main company. The executives who ran Enron were extraordinarily creative in designing these entities to remain just barely outside the technical boundaries of what accounting rules required to be consolidated into the main statements. From the outside, Enron appeared to be a lean, highly profitable, and rapidly growing energy company leading the transformation of its industry. Behind the scenes, it was deeply loaded with debt and riddled with losses that were being carefully and systematically hidden from public view. When the elaborate structures eventually began to unravel under closer scrutiny, the company's true financial condition was exposed in all its catastrophic difference from what had been publicly reported. The warning signs for off-balance sheet manipulation are found, more than anywhere else, in the detailed footnotes of financial statements. Companies are required by regulation to disclose the existence of off-balance sheet arrangements, even in cases where they are not required to include those arrangements in the main consolidated financial statements. But the vast majority of investors never spend time reading the footnotes. This is exactly where many of the most important revelations about a company's true financial condition are hidden, often deliberately obscured in language that is technical, dense, and difficult for non-specialists to interpret quickly. When you see references in the footnotes to special purpose entities, variable interest entities, operating leases of very large scale and long duration, or significant unconsolidated affiliates, these disclosures are worth investigating more carefully before trusting the headline numbers. Another technique for making expenses less visible involves the strategic use of stock-based compensation in ways that minimize or eliminate the apparent cost to the company. Companies routinely pay their employees partly in stock options and stock grants, which are a completely real and economically significant form of compensation that carries a genuine cost. For many years, accounting rules actually permitted companies to avoid expensing stock options on the income statement entirely, even though those options had substantial economic value. Companies exploited this loophole aggressively to offer extremely generous compensation packages that looked inexpensive on paper, simply because the cost of those options never appeared in the reported earnings figures. Even after accounting rules were eventually changed to require the expensing of stock options, companies found creative ways to minimize the apparent cost by making assumptions about the value of those options that were, in some cases, unrealistically and conveniently low. When you encounter a technology company with hundreds or thousands of well-compensated employees enjoying spectacular total compensation packages, but the stock compensation expense appearing on the income statement looks surprisingly and suspiciously small, it is genuinely worth questioning the underlying assumptions management has made in calculating that expense and whether those assumptions bear any reasonable relationship to market reality. Now let us explore a more counterintuitive form of earnings manipulation, one where companies actually try to reduce their current reported income on purpose. This might seem completely strange at first glance. Why on earth would any company want to deliberately report lower earnings than it could otherwise show? The answer has everything to do with managing future expectations and creating hidden reserves for use in periods when actual performance falls short. The specific technique is called shifting current income to a later period, and it is most commonly employed when a company is experiencing an extraordinarily strong quarter or year. Management may decide to hold back some portion of the income from the current period by being more conservative than strictly necessary in revenue recognition, or by being more aggressive than genuinely required in building up various kinds of reserves in order to have a financial cushion that can be drawn down in future periods when operating performance might turn out to be weaker. This practice is sometimes called cookie jar accounting in the investment world, because management is essentially putting cookies in a jar during the good times and pulling them out during the difficult times to make results always appear smooth, steady, and predictable. While this might sound relatively harmless or even sensibly prudent, It is actually a deceptive form of manipulation because it systematically misleads investors about the true timing and true magnitude of the company's actual performance in each period. Investors deserve to see the honest results of each reporting period, not a management-smoothed version that has been carefully pre-adjusted to manage external impressions and expectations. The recognizable sign of cookie jar accounting is when a company reports a particularly large special charge in a given period that looks bigger than the circumstances seem to require, followed over subsequent periods by a series of small but convenient gains appearing from the reversal of those earlier provisions. If you observe this pattern repeating, it suggests strongly that management is using the original charge as a mechanism for building up hidden reserves that it will release back into reported income when needed to make future quarters look better. Connected to this is a technique called the Big Bath, which is one of the most brazen and aggressive forms of earnings manipulation practiced by publicly traded companies. A big bath typically occurs in one of two situations. The first is when a company is already experiencing a genuinely terrible year, and management decides that since results are going to look bad regardless, they may as well make them look as catastrophically bad as possible. The second is when new management has just taken over a company and wants to blame every possible problem on the previous leadership team while starting their own tenure with a clean financial slate. The mechanics of a big bath involve throwing every conceivable write-off, reserve, and charge that can be justified into a single bad reporting period, making that period look horrifying, but ensuring that all subsequent periods will appear clean, strong, and improving by comparison. When a new chief executive arrives at a troubled company and announces a massive restructuring program with enormous associated charges, writes off vast amounts of old inventory or goodwill, takes large provisions for various contingencies and potential liabilities, and generally makes the inherited situation look as grim as possible, investors should ask hard questions about whether the magnitude of those charges genuinely reflects economic reality, or whether management is being strategically generous with its write-offs to create financial buffers for the future. For investors evaluating big bath charges, the critical assessment is whether the write-offs honestly reflect the actual impairment of real assets and the genuine costs of any restructuring program, or whether they include excessive and strategically motivated charges that create hidden reserves to be quietly released into income during future periods when the business needs a boost to meet market expectations. We now arrive at one of the most important and genuinely insightful sections of our entire journey together, the world of cash flow shenanigans. This is where Schilit's work becomes particularly valuable and eye-opening, because many experienced investors have learned over time to look skeptically at reported earnings while continuing to place much stronger trust in cash flow as a more reliable and honest measure of business health. Cash is harder to manufacture than profits, the conventional thinking goes, because unlike accounting profits, cash either physically arrives in the bank account or it simply does not. But Schilit reveals with compelling evidence that cash flow can also be manipulated in surprisingly effective and sophisticated ways. Understanding how this is done will make you a substantially better investor than the vast majority of market participants. The cash flow statement that every public company publishes is divided into three distinct sections. The first section covers operating cash flow, representing the cash generated by the company's core day-to-day business activities. The second section covers investing cash flow, representing cash that the company has spent on or received from long-term investments, such as purchasing equipment, acquiring other companies, or selling business assets. The third section covers financing cash flow, representing cash flows related to borrowing money from banks or bond markets, repaying existing debt, issuing new shares to investors, or returning cash to shareholders through dividends or buybacks. Of these three sections, operating cash flow is unquestionably the most important for investors to focus on. When a company consistently generates strong operating cash flow, it is genuine evidence that the core business is actually producing real money, not just accounting profits that exist primarily on paper. Investors and professional analysts watch operating cash flow very carefully as a result. This intense and understandable attention creates a corresponding and powerful incentive for companies to find ways to make this number look as strong and as healthy as possible. The first major cash flow shenanigan involves the deliberate shifting of financing cash inflows into the operating section of the statement. Here is how this actually works in practice. A company might arrange a specific deal with a financial institution where it effectively borrows money, but structures the transaction in a precise way that makes the incoming cash appear to come from normal business operations rather than from a loan. Alternatively, a company might sell its accounts receivable, which are the amounts owed to it by customers, to a bank or other financial institution in a transaction structure called securitization. Under certain precisely engineered arrangements, the cash received from this sale can be classified and presented as operating cash flow, even though its true economic substance is really a form of short-term borrowing that will effectively need to be repaid when the underlying receivables are collected. Consider carefully what this does to the reported numbers. The company appears to be generating vigorous cash from its normal business operations. Investors and analysts are impressed and assign a premium valuation to what appears to be a highly cash-generative business. But the reality that is being hidden is that the company has simply borrowed money in a disguised form and classified it as something it is not. Eventually, that borrowed money must be repaid in one form or another, and the disguise becomes impossible to sustain. One practical warning sign for this type of manipulation is when a company's reported accounts receivable balance grows much more slowly than its revenue, or actually declines while revenue is growing. This can sometimes indicate that the company is actively selling or securitizing its receivables off the balance sheet, generating cash inflows that then appear deceptively in the operating section of the statement. Another warning sign is when detailed reading of the footnotes reveals arrangements where the company has sold receivables but retains certain continuing involvement or risk in the performance of those receivables, which strongly suggests that the sale may really be a disguised borrowing rather than a genuine arm's-length transfer. The second major cash flow shenanigan works in the opposite direction, involving the shifting of what should be normal operating cash outflows into the investing section of the statement. Remember that cash that flows out as a long-term capital investment is not counted against operating cash flow. So if a company can successfully reclassify a normal operating expense as a capital investment in the financial statements, its operating cash flow will appear stronger even though the total amount of cash leaving the company is identical. This is, in its essential structure, the cash flow version of exactly the same trick that WorldCom used on its income statement when it capitalized its network line costs. By treating those recurring payments as capital investments rather than operating expenses, WorldCom not only inflated its reported accounting profits, but simultaneously inflated its apparent operating cash flow, because the actual cash payments were flowing through the investing section of the statement rather than properly reducing the operating cash flow figure. The manipulated numbers looked dramatically healthier than the economic reality warranted. The warning sign for this type of shenanigan is when a company's capital expenditures appear unusually high relative to both its revenues and to what comparable companies in the same industry are spending. This does not automatically or definitively mean something dishonest is happening. Sometimes, companies genuinely need to invest very heavily in their infrastructure or capabilities. But when the level of capital investment looks unusual, and management cannot provide a convincing and specific explanation of what durable long-term assets it is creating with that spending, and when operating cash flows look suspiciously healthy for a business that appears to need such heavy investment, the combination merits deeper examination. The third major cash flow shenanigan involves inflating reported operating cash flow by using acquisitions and disposals in strategic ways. When a company acquires another business, The combined entity after the transaction can appear to generate more operating cash than the acquirer was producing on its own before the deal. And when a company sells a subsidiary or a business division, it may receive ongoing cash payments that it classifies within the operating section of the cash flow statement, even though these payments are economically the proceeds of a capital asset disposal. One specific and instructive version of this technique involves a company acquiring another business that happens to hold a large cash balance, or that is generating a temporary and unsustainable cash windfall around the specific timing of the acquisition. The combined reporting entity then presents impressive operating cash flows in the period immediately following the acquisition, even though the acquired company's cash-generating capabilities may deteriorate significantly over the subsequent quarters once the temporary boost has been absorbed. Investors who are seriously evaluating a company's cash-generating quality should always attempt to understand the organic cash flow generation of that business in isolation, meaning how much cash the company generates from its own existing operations, completely separate from the distorting effects of recent acquisitions and disposals. When a company is a serial acquirer, constantly buying new businesses, quarter after quarter and year after year, it becomes extremely difficult for any outside investor to assess clearly whether the underlying organic operations are genuinely improving or whether they are quietly deteriorating beneath the surface of the deal-driven growth story. The fourth major cash flow shenanigan is different in character from the previous three because it does not involve accounting reclassifications or structural tricks. Instead, it involves boosting reported operating cash flow through real but fundamentally unsustainable business activities, actions that improve the cash numbers in the short term at the direct expense of the company's future performance. One clear example of this type of activity is when a company dramatically accelerates its squeeze on the working capital components of its business. It might aggressively pressure its suppliers into accepting significantly extended payment terms, which delays cash outflows and boosts apparent cash generation. It might push its own customers very hard to pay faster than they otherwise would, accelerating cash inflows. It might run down its inventory to very lean levels, freeing up cash that was previously tied up in stock. All of these actions do genuinely produce real cash in the short term, and they will show up as improvements in reported operating cash flow. The problem is that these improvements are inherently one-time in nature. You can only extend supplier payment terms so far before suppliers simply refuse to continue working with you on acceptable commercial terms. You can only accelerate customer collections so aggressively before customers begin taking their business to competitors who are more accommodating. You can only strip inventory so thin before you start losing sales because you cannot fulfill customer orders promptly. When you observe a company reporting apparent improvement in operating cash flow that appears to be driven primarily by changes in working capital, rather than by genuine and sustainable improvements in underlying profitability and business performance, you should always ask whether this improvement is something that can plausibly be sustained in future periods, or whether it represents a one-time harvest of cash that has simply been borrowed from the future. Another form of unsustainable activity that temporarily boosts cash flow involves the deliberate cutting of genuinely necessary expenses. A company facing cash pressure might defer maintenance on critical equipment, dramatically reduce investment in research and development activities, cut back on employee training programs, or reduce the capital investment it makes in sustaining and growing its productive asset base. These expenditure cuts make the near-term cash numbers look dramatically better, but they progressively erode the long-term competitive position of the business and its future earning capacity. By the time investors and analysts fully realize what has been happening and what has been sacrificed, the damage to the fundamental business is already deeply embedded and very difficult to reverse quickly. Now we move into the third major category of financial shenanigans, the manipulation of key business metrics. This is a more recent phenomenon that has grown in prominence alongside the rise of technology companies and various other modern businesses that routinely report their own custom-invented measures of performance alongside, or sometimes effectively in place of, the standard financial statement metrics that accounting rules require. Companies in these situations often make the argument that standard accounting measures genuinely fail to capture what is truly and most meaningfully happening in their particular type of business. A technology company might contend that the growth in its monthly active user base is far more important to understanding the value of its business than its current period accounting profits. A subscription-based business might argue that the estimated lifetime value of its customer relationships is a more relevant and forward-looking indicator than the current period cash flows. There is often genuine and legitimate merit to arguments of this kind. Standard accounting frameworks can sometimes be poorly suited to capturing the true economics of highly innovative or genuinely novel business models. But the serious problem arises when companies have complete freedom to invent and selectively report their own performance metrics, because they then have every possible incentive to choose metrics that make their situation look favorable, to define those metrics in ways that maximize the reported numbers, and to change the definitions whenever the original versions of those metrics begin to look less flattering or less supportive of the current management narrative. Schilit correctly identifies this as a category of shenanigans in its own right, because systematically misleading custom metrics can and regularly do cause investors to pay prices for stocks that bear no rational relationship to the underlying economic reality of the businesses they own. The first key metrics shenanigan involves the deliberate showcasing of custom measurements that overstate the company's true underlying performance. Companies in the earliest waves of e-commerce were particularly creative in this regard, inventing metrics tailored specifically to justify their extremely high valuations when genuinely profitable customers were rare and difficult to find. Those early internet companies reported the total number of registered email addresses in their databases, or the total number of daily page views, or the gross merchandise volume flowing through their platforms, all of which sounded like meaningful measures of scale and momentum, but did not actually tell any investor whether the company was building something that would ever generate real profits. More recent examples of this kind of metric manipulation come from the world of subscription-based businesses, which frequently report a figure called monthly recurring revenue or annualized recurring revenue that is designed to represent the current run rate value of their customer subscriptions. This can genuinely be a useful and informative metric when it is carefully and honestly defined. But companies sometimes define these figures in ways that include one-time payments, payments from customers who are already in the process of canceling their subscriptions, or other types of revenue that are not actually recurring in any meaningful sense. When the definition of the key metric is generous in ways that maximize the reported number, and when that metric is presented prominently in investor communications, while the standard financial statement metrics are buried or downplayed, investors face a real and material risk of being systematically misled about the true trajectory of the business. The key practical warning sign here is when management places very heavy emphasis on a custom metric while paying comparatively little direct attention to the standard financial statement metrics. Before accepting any such custom metric at face value, ask yourself what management's genuine motivation is for highlighting this particular measure. Is it because this metric truly captures something economically important and strategically meaningful that standard metrics genuinely miss? Or is it because the standard metrics paint an uncomfortable or unflattering picture, and this custom metric happens to tell a more attractive story? The second key metrics shenanigan in Schilit's framework involves the deliberate distortion of balance sheet metrics to prevent investors from clearly seeing deterioration in the company's financial health. Balance sheet ratios are widely used by professional investors and financial analysts to assess the financial strength and stability of any given company. Measures like the ratio of current assets to current liabilities, the level of total debt relative to shareholder equity, the book value of net assets per outstanding share, and similar metrics are all signals that the investment community monitors on a regular basis. Companies sometimes manipulate these critical ratios through very precise timing of specific transactions, through off-balance sheet arrangements that remove liabilities from the reported balance sheet entirely, or simply by defining the components of these metrics in non-standard ways when they present them to investors. A company might arrange to make a particular debt repayment or to temporarily reduce its borrowings just before the end of a reporting period to make its balance sheet look cleaner at the exact moment of measurement, only to borrow the money back again shortly after the reporting date when investors are no longer looking as closely at the specific numbers. The systematic use of operating leases, rather than outright ownership of business assets, is a related and historically very important example of this category of balance sheet manipulation. Under the accounting standards that prevailed for many years prior to relatively recent reforms, companies that lease their office buildings, retail stores, warehouses, or equipment under operating lease arrangements were not required to record the corresponding obligations as liabilities on their balance sheets. This allowed companies that heavily leased their productive assets to appear far less indebted than comparable companies that owned similar assets. Investors who compared balance sheet debt levels between companies in the same industry without carefully and properly adjusting for off-balance sheet operating lease obligations were making systematically flawed comparisons that could lead to very poor investment decisions. The third key metrics shenanigan involves the distortion of cash flow metrics through the increasingly widespread practice of reporting heavily adjusted versions of free cash flow. Just as companies manipulate the standard operating cash flow figure that appears in the formal cash flow statement, they also present custom cash flow metrics in investor communications that are designed to look more attractive than the numbers that can be derived from the financial statements themselves. Free cash flow, in its standard and most widely accepted definition, represents operating cash flow minus the capital expenditures that a business needs to maintain and grow its productive asset base. This figure is intended to represent the cash that the business genuinely and freely generates after sustaining its ability to continue competing effectively. But when companies begin making extensive adjustments to this figure, excluding stock-based compensation costs, excluding restructuring charges, excluding integration costs from acquisitions, and adding back various other items that management decides to label as non-recurring, the resulting adjusted free cash flow figure can deviate very substantially from the economic reality of what the business is actually delivering to its shareholders in any given period. The alert investor should always be concerned when there is a persistent, large, and widening gap between a company's heavily adjusted free cash flow figure, as reported by management, and the figure you would arrive at using only the standard components drawn directly from the formal financial statements. A gap of this kind does not always and necessarily indicate fraudulent intent, but it does strongly suggest that management is presenting its cash generation in the most favorable possible light, and any investor relying on those adjusted figures deserves to understand very specifically what is being excluded and why those exclusions are genuinely justified. Let us now take a step back from the detailed mechanics of individual shenanigans and consider the broader patterns and environmental contexts that make financial manipulation more probable. Understanding when and why companies are most severely tempted to manipulate their reported numbers is just as important for investors as knowing the specific technical tricks that get employed. One of the most powerful and consistent predictors of financial manipulation is intense pressure. Companies operating under severe pressure to meet Wall Street earnings expectations, to show the kind of revenue growth that is needed to sustain an extremely high stock valuation, or to avoid violating the specific financial covenants in their debt agreements, are substantially more likely to resort to manipulation than companies that are not under comparable levels of pressure. This insight should make investors particularly vigilant when examining any company that has established very high expectations for itself, that trades at a very elevated multiple of its earnings or book value relative to history and peers, or that is carrying a significant and constraining level of debt relative to its cash-generating capacity. The technology sector has historically been among the most fertile environments for financial shenanigans to flourish, precisely because technology companies so frequently generate extreme investor excitement and consequently trade at very high valuations relative to their current fundamentals. When a company is priced for absolute perfection, any shortfall in reported results relative to market expectations can trigger a dramatic and painful decline in the stock price. Management teams in this situation are acutely aware of this dynamic, and the resulting pressure to deliver smooth, consistently impressive quarterly results can become genuinely overwhelming in ways that gradually erode ethical standards. Companies and industries experiencing fundamental disruption or long-term structural decline present a somewhat different but equally potent motivation for financial manipulation. A traditional business model facing a genuinely existential competitive threat might use accounting techniques to temporarily disguise the accelerating deterioration of its core economics. The accounting tricks buy time, they delay the inevitable day of reckoning with investors, and they allow management teams to collect their compensation and exercise their equity awards while the underlying business quietly erodes. The manipulations do not fix anything. They simply make the problem harder to see until it is much larger and harder to address. The incentive structures facing individual executives represent another major determinant of the probability of financial manipulation. When management team members stand to receive very large financial rewards based specifically on short-term reported financial metrics, and when those rewards vest quickly and can be captured without any long-term accountability for results, the incentives to manipulate those metrics are at their most powerful and most dangerous. Stock options that vest in just 1 or 2 years, quarterly bonuses tied directly to earnings per share or revenue growth, and similar short-term incentive arrangements all create powerful personal financial motivations to manage reported numbers aggressively. This is why the most sophisticated investors pay direct and specific attention to the compensation structure of management teams before committing capital to any company. When the primary financial rewards facing executives are tied to short-term metrics that can be influenced through accounting choices, and especially when there is no effective clawback mechanism that would allow the company to recover compensation that was paid based on results that turned out to have been fraudulently produced, the underlying incentive environment for financial manipulation is at its most dangerous. Let us now look more deeply at several historical cases that illustrate these dynamics with exceptional clarity, because there is no more powerful educational tool than carefully studying real examples of how things actually went wrong. Health South Corporation provides one of the most instructive examples of systematic and sustained earnings manipulation in the healthcare industry. Health South was the largest provider of rehabilitation hospital services in the United States during the 1990s and early 2000s. For years, it reported impressive financial results that kept its stock price elevated and its executives well compensated. What was actually happening behind the reported numbers was that management had been systematically manipulating the company's earnings for many consecutive years to ensure that reported results consistently met or exceeded analyst expectations. The manipulation at Health South involved numerous accounting departments and employees across the organization, making it unusually broad-based for a corporate fraud. Accounting entries were fabricated, assets were overstated, and revenues were inflated in a coordinated effort to close the gap between what the business was actually generating and what the company had promised Wall Street it would deliver. The scheme persisted for so long because it was deeply embedded in the company's accounting culture and because the people who might have detected it were either directly involved or were under intense pressure not to look too closely. When federal investigators finally uncovered the scheme, the resulting restatements and legal proceedings consumed enormous resources and caused massive losses for investors who had trusted the company's reported results. Waste management provides another deeply instructive example, particularly because of the very specific accounting technique it employed on a large scale over an extended period. Waste Management was the dominant solid waste company in the United States during the 1990s. Over a period of many years, company management manipulated reported earnings primarily by extending the estimated useful lives of the garbage trucks and other collection equipment that constituted its primary operating assets. By assuming that this equipment would remain productive for longer than honest accounting judgment would support, management was able to significantly reduce the depreciation charges that were recognized each year in the income statement. This had the direct effect of making reported profits appear substantially higher than they would have been under accounting policies consistent with those of the company's industry peers. The scheme was straightforward in concept, but was sustained for many years and eventually resulted in the largest accounting restatement in American corporate history up to that point, and in substantial financial penalties and legal consequences for the executives responsible. Global Crossing and Quest Communications, two major telecommunications companies operating during the technology boom of the late 1990s, employed a particularly creative technique to inflate their reported revenues. Both companies engaged in what came to be known as capacity swaps, a practice where they essentially traded network capacity rights with each other in transactions that were structured to generate recorded revenue for each party. Company A would sell the right to use a specific portion of its fiber optic network to Company B, while Company B simultaneously sold the right to a portion of its own network back to Company A. Each company then recorded its sale as revenue. On the surface, both companies appeared to be growing their businesses and generating meaningful revenue from the commercialization of their network capacity. In economic substance, however, no real business had been done. The same capacity was simply changing hands and changing back in a circle, and the recorded revenue on each side had no corresponding real economic value. When the underlying economics of these transactions became clear to regulators and investors, both companies were forced into bankruptcy. Parmalat, the Italian dairy and food products giant, provides one of the most dramatic international examples of financial fraud in corporate history. For years, Parmalat maintained on its balance sheet what appeared to be billions of euros in cash and liquid investments held in offshore bank accounts. These apparent cash holdings were a key component of the financial picture management presented to investors and creditors because they suggested the company was financially secure despite carrying substantial debt. When outside investigators finally began examining the specific documentation behind these claimed cash balances, they discovered that the accounts were largely fabricated. The bank account statements supporting the claimed cash balances were forged documents. The money that Parmalat claimed to hold simply did not exist. The fraud had persisted for years because auditors and creditors had accepted the documentation at face value without independently verifying the account balances directly with the financial institutions where the accounts were supposedly held. Satyam Computer Services in India provides yet another instructive international case. In 2009, the chairman of Satyam publicly admitted that the company had been systematically falsifying its financial statements for many years, overstating cash balances, inflating revenues, and fabricating customers and orders. The fraud had created a gap of hundreds of millions of dollars between the reported financial position and the actual economic reality of the business. What made the Satyam case particularly shocking was that the company had received numerous awards for excellence in corporate governance, suggesting that the external signals investors and analysts typically use to assess management integrity are far from perfectly reliable. These cases, taken together, illustrate several powerful and consistent themes. The manipulation in each case was driven by intense pressure on management to meet market expectations that the underlying business could not honestly satisfy. Warning signs were present in the financial statements or in the management behavior of each company long before the fraud became public knowledge. The auditors and other gatekeepers failed to detect or adequately report the manipulation, and the financial losses suffered by investors who placed their trust in the reported numbers were severe and, in many cases, permanent. Now, let us discuss the analytical tools and frameworks that investors can practically apply to detect potential manipulation in the companies they are evaluating or currently own. The goal is to develop a concrete and repeatable process, not to turn every investor into a specialist forensic accountant, which would be neither practical nor realistic for most people. The most fundamental analytical tool available to every investor is the simple comparison of reported earnings to reported cash flow. As we have discussed at length, earnings can be manipulated in a wide variety of ways, but genuinely sustainable cash flow is considerably more difficult to fake over extended periods. When a company consistently reports strong accounting profits but generates weak or deteriorating operating cash flow, this divergence is a significant and meaningful warning signal that deserves to be taken seriously. The difference between reported profit and operating cash flow is sometimes described in terms of what professionals call the accruals component of earnings. A company with a large and growing accruals component is essentially reporting profits that have not yet been collected as actual cash and may never be collected. The reverse pattern is also interesting and important, though for a very different reason. When operating cash flow consistently and substantially exceeds reported accounting profits over time, this can sometimes indicate that the company is applying very conservative accounting policies that cause reported profits to understate its true underlying earning power. This is the situation that value-oriented investors typically prefer because it suggests that the financial statements are more likely to be understating rather than overstating the company's genuine economic performance. The DuPont Analytical Framework represents another valuable tool for evaluating the quality and sustainability of reported returns. This framework systematically breaks down a company's return on equity into three distinct components, which are the profit margin, the asset turnover ratio, and the degree of financial leverage. By carefully examining how each of these components has changed over time and how they compare to industry peers, you can develop specific insights into whether improvements in reported returns reflect genuine operational progress or whether they are being driven by accounting manipulation, asset sales, or simply increasing levels of debt that amplify returns in the near term but increase risk significantly. The Beneish M-score is a statistical detection model that was specifically developed and empirically validated to identify companies with elevated probability of having engaged in earnings manipulation. The model uses a combination of 8 financial ratios that research has shown to be associated with manipulation, including changes in the relationship between days sales outstanding and prior period levels, changes in gross profit margins over time, the growth rate of assets relative to the growth rate of revenues, and the relationship between the growth of accruals and the growth of the overall asset base. The model generates a composite score, and companies with scores above a specific threshold are classified as having a higher probability of manipulation. While no statistical model produces perfect results in all cases, the Beneish model has demonstrated meaningful predictive power in academic research and is worth incorporating into a comprehensive financial analysis process. As we continue through this exploration, it is worth spending time on the specific question of how investors should approach their analysis of any individual company in a practical and systematic way. Let us walk through a concrete process that builds on everything we have discussed so far. The starting point for any serious analysis of financial reporting quality is to obtain and actually work through the complete set of a company's financial statements, not just the summary highlights that management chooses to emphasize in press releases and investor presentations. This means the full income statement with all line items, the complete balance sheet, the detailed cash flow statement in its entirety, and crucially, all of the associated footnote disclosures that accompany the main financial statements. In examining the income statement, focus particularly on the revenue recognition policies described in the accounting policy footnotes and compare those policies carefully to what competitors in the same industry are doing. Look at the trend in gross margins over time and investigate any significant changes, because gross margins can be affected by a wide range of accounting choices, including how costs are classified, when revenue is recognized relative to when the associated costs are incurred, and how inventory is valued. Look at the size and nature of any special charges, gains, or other non-recurring items, and develop a clear picture of what earnings from core continuing operations look like when these items are stripped out. In examining the balance sheet, track the trends in key working capital components over multiple reporting periods. Specifically, monitor accounts receivable relative to revenue, inventory relative to cost of goods sold, and accounts payable relative to operating expenses. Look for significant changes in the level of goodwill or other intangible assets, which can be inflated through aggressive acquisition accounting or maintained at unrealistically high levels through insufficient impairment charges. Look carefully at the total level of financial obligations, including all forms of debt, lease obligations, pension liabilities, and other contingent claims on the company's cash flows. In examining the cash flow statement, compare operating cash flow to net income and track this relationship over multiple periods. Look at the level of capital expenditures and the specific items that management classifies as capital investments, comparing both the level and the composition to industry peers. Check whether accounts receivable is being securitized or otherwise sold in ways that affect the classification of cash flows. And look for any unusual items in the financing section that might shed light on the actual sources of cash that the company is using to sustain its operations. Beyond the financial statements themselves, there are several other important sources of information that investors should regularly consult when evaluating any company. The proxy statement, which is the annual document that provides detailed information about executive compensation arrangements, board composition, and significant governance issues, is an essential source of information about the incentive structures facing management and any potential conflicts of interest that might affect the quality of financial reporting. The management discussion and analysis section of the annual report, which is prepared by management itself and is intended to provide context and explanation for the financial statement results, should be read both for its content and for what it carefully avoids discussing. Pay attention to the language management uses to explain changes in results. When management uses vague, general language to explain specific financial changes, or when it consistently emphasizes certain metrics while avoiding direct discussion of others, these patterns can be informative signals about where management is uncomfortable drawing direct attention. Regulatory filings made in connection with equity offerings, debt issuances, or mergers and acquisitions sometimes contain additional financial disclosures or audited financial information that is not routinely provided in the standard annual and quarterly reports. These supplemental documents can sometimes reveal information about the company's financial condition that is not highlighted in the normal course of investor communications. It is also genuinely valuable to seek out what critics and skeptics of a company are saying. When professional short sellers have taken positions against a company and published their research explaining why, reading that research can provide a very different perspective from the uniformly positive narrative that management tends to present. Short sellers have strong financial incentives to identify and publicize genuine problems with a company's financial reporting or business model. While not all short seller criticism is valid, it is worth taking seriously and evaluating against the primary financial data. This connects to an important and broader psychological principle about effective investment analysis. Confirmation bias, the deeply human tendency to search for and give disproportionate weight to information that confirms what we already believe or want to believe, is one of the most dangerous psychological traps facing any investor. When we have invested time and money in a company, or when we are attracted to an exciting story or a compelling CEO, we naturally tend to interpret ambiguous information in the way most favorable to our existing thesis. Effective detection of financial shenanigans requires deliberately and systematically seeking out disconfirming evidence, looking actively for the reasons a company might be performing less well than its reported numbers suggest, and taking that evidence seriously even when it challenges our existing views. The psychological environment surrounding celebrated companies and market favorites is particularly dangerous in this regard. When a company is being widely praised in the financial media, when its CEO is appearing on magazine covers and delivering keynote speeches at major conferences, and when anyone who raises questions about the company's accounting or business model is publicly dismissed as someone who simply does not understand the business, the social pressure to accept the prevailing positive narrative can be overwhelming even for sophisticated and experienced investors. Some of the most spectacular financial frauds in history were protected for extended periods by exactly this kind of social dynamic, where the enthusiasm of the investment community and the financial media created an environment in which questioning the company was professionally and socially costly. Enron is again the most vivid example. Through much of its history, as a publicly traded company, Enron was celebrated in the financial press as one of the most innovative and forward-thinking companies in America. Its executives gave speeches at prestigious academic institutions. It was repeatedly named to lists of the most admired companies in the country. Analysts who dared to publish skeptical assessments of its financial reporting or its business model faced significant professional criticism and were publicly accused of failing to understand a genuinely revolutionary company. The analytical courage required to maintain a skeptical stance in that environment was considerable, and most market participants simply went along with the prevailing narrative. The lesson that this history teaches is both important and uncomfortable. Sometimes, the most important investment decision you make is the one to not follow the crowd, to trust your own careful analysis of the financial evidence over the weight of social consensus and enthusiastic narratives. This requires not just analytical skill, but genuine intellectual independence and the willingness to be wrong publicly for a period before the evidence eventually vindicates the skeptical view. Schilit's framework provides exactly the kind of systematic, evidence-based foundation that enables this kind of independent analytical judgment. By focusing on specific, observable, quantifiable signals in the financial statements, rather than on management narratives and market sentiment, investors can develop views that are genuinely grounded in the underlying economic reality of a business, rather than in the story being told about it. As we approach the concluding portion of our exploration, let us think carefully about the systemic factors that make financial shenanigans a persistent and recurring feature of the investment landscape, despite decades of regulatory reform, enhanced accounting standards, and growing investor sophistication. One of the most fundamental reasons is the inherent tension between accounting rules and economic reality. Accounting rules are necessarily general in nature, designed to apply across a vast diversity of business models, industries, and transaction types. No set of rules can perfectly capture the economic reality of every possible business situation. This means that there will always be gray areas, ambiguous situations, and judgmental estimates that give management teams varying degrees of latitude in how they present their financial results. Where latitude exists, the temptation to use it in self-serving ways will always be present. Another deeply structural reason for the persistence of financial manipulation is the enormous financial stakes involved. When a corporate executive can personally receive tens of millions of dollars in compensation and equity gains by reporting results that consistently meet or slightly beat market expectations, the financial incentive to manipulate those results is extremely powerful. The expected financial payoff from successful manipulation is very large, while the probability of detection in any given reporting period is often relatively low. And even in cases where manipulation is eventually detected and prosecuted, the legal penalties imposed have sometimes been modest in comparison to the financial gains captured by those involved. Regulatory frameworks have been substantially strengthened over the past several decades in response to major accounting scandals. The Sarbanes-Oxley legislation, passed in the United States in 2002, significantly increased the personal legal accountability of senior executives for the accuracy of financial statements, required more rigorous independent standards for corporate boards and audit committees, and established stronger oversight of the public accounting profession. Similar reforms were adopted in various other major markets around the world. These changes genuinely improved the financial reporting environment in meaningful ways, but they did not, and could not, eliminate the fundamental incentive for manipulation or the technical ability of sophisticated executives and advisors to exploit ambiguities in the rules. More recently, regulators have increasingly employed advanced data analytics technologies to monitor financial reporting across large populations of companies simultaneously, looking for statistical patterns that may indicate manipulation. By analyzing the full universe of public company financial data, regulators can identify companies whose reported results look anomalous in ways that might not be obvious from looking at any individual company in isolation. This technological approach to regulatory oversight has real promise for improving the detection of manipulation, but sophisticated management teams and their advisors continuously adapt their techniques in response to changing enforcement patterns. There is also an important cyclical dimension to financial shenanigans that investors should understand. Accounting manipulation tends to be most prevalent and most difficult to detect during periods of broad economic expansion and market enthusiasm. When credit is freely available, when revenue is generally growing across most industries, and when investors are optimistic about future prospects, the conditions that allow manipulation to persist are at their most favorable. Companies can sustain manipulated earnings figures for longer during good times because the underlying business performance, while weaker than reported, is still strong enough to prevent the most obvious warning signs from becoming overwhelming. It is when economic conditions deteriorate, when credit tightens, when revenue growth slows or reverses, and when investor scrutiny intensifies, that financial manipulation becomes unsustainable. The famous observation, attributed to Warren Buffett, that you only discover who has been swimming without clothes when the tide goes out, applies with particular force to companies that have been sustaining their reported results through accounting manipulation. The economic tide going out strips away the accounting disguise and reveals the true underlying condition of the business. For practical purposes, this means that periods of market stress and economic difficulty are paradoxically among the best times to learn which companies in your portfolio or investment universe have been sustaining their reported results through manipulation rather than genuine business performance. The companies that maintain their reported results and their cash flows during difficult economic periods without resorting to massive asset sales or extraordinary accounting adjustments are demonstrating the kind of genuine resilience and business quality that deserves long-term investment. The companies whose numbers suddenly collapse in a dramatic fashion when economic conditions become more challenging may have been hiding their true condition through manipulation during the better times. The environment for emerging forms of financial shenanigans continues to evolve rapidly. Special purpose acquisition companies, commonly called SPACs, became extremely popular as a mechanism for taking private companies public during the period from approximately 2020 through 2022. Many of the companies that went public through SPAC transactions made extremely ambitious and, in some cases, wildly optimistic projections about their future financial performance that were used to justify their proposed valuations. The regulatory structure governing SPAC transactions allowed companies to present these forward-looking financial projections in ways that would not have been permitted under the more stringent disclosure requirements applicable to traditional initial public offerings. When the underlying business performance of many SPAC companies failed to approach the optimistic projections that had been used to sell the transactions, investors suffered very significant losses. Environmental, social, and governance reporting has also become a growing area of concern from a financial shenanigans perspective. As investors increasingly incorporate ESG factors into their investment decisions, companies face growing incentives to present their ESG credentials in the most favorable possible light. Many ESG claims are based on self-reported metrics that lack independent verification, and the methodologies used to calculate these metrics are often complex, non-standardized, and selected in part based on which methodology produces the most favorable result. Greenwashing, the practice of making environmental claims that overstate a company's actual environmental practices or credentials, has been identified by regulators in multiple major markets as a significant and growing concern that parallels the earnings quality issues Schilit identified in traditional financial reporting. As we bring this exploration to its conclusion, let us distill the most important and practically actionable principles that every investor should carry forward from what we have covered together. The first and most fundamental principle is that reported earnings can mislead you in many ways. Never make important investment decisions based solely on earnings per share, net income, or profit margins without carefully evaluating the quality and sustainability of those earnings and the accounting policies that produce them. The second principle is that cash flow is a more reliable guide to business reality than accounting profit, but it is not perfectly reliable either. Operating cash flow should be compared to reported net income in every company you evaluate, and significant and persistent divergences between these two figures should always be thoroughly investigated before you are comfortable with your investment. The third principle is that the footnotes to financial statements contain some of the most important information available about a company. Develop the habit of reading the revenue recognition policy, the disclosures about related party transactions, the contingent liability disclosures, and any changes in accounting policies for every company you own or seriously consider owning. The fourth principle is that comparison to industry peers is indispensable for proper evaluation. No financial metric has much meaning in complete isolation from context. It is only when you compare a company's accounting policies, growth rates, margins, and cash conversion characteristics to those of comparable companies that you can assess whether apparent outperformance reflects genuine business excellence or simply accounting aggressiveness. The fifth principle is that management incentives powerfully drive reporting behavior. Always understand specifically how the executive team is compensated and what performance metrics their personal financial rewards are tied to. When management is richly rewarded based on short-term financial metrics that can be influenced through accounting choices, the underlying incentive environment for manipulation is at its most dangerous. The sixth principle is that patterns observed over time are more meaningful than any single data point. A single unusual increase in accounts receivable in one quarter might reflect entirely legitimate business circumstances, but receivables growing persistently faster than revenue over 5 or 6 consecutive quarters, combined with deteriorating operating cash flow trends, represents a pattern that is qualitatively different and demands serious investigation. The seventh principle is that narrative and numbers must be internally consistent. Every company tells a story about how it is creating value. That story should be directly consistent with and supported by the actual financial data. When management describes a company that is growing profitably and generating strong cash returns, but the financial statements show slowly increasing debt, deteriorating cash conversion, and building receivables, the gap between story and data is itself a meaningful warning. The eighth principle is that appropriate skepticism is among the most valuable attributes any investor can cultivate. Not a paralyzing skepticism that prevents all investment action, but a productive, evidence-based skepticism that drives you to ask the right questions, to seek out evidence that might disconfirm your existing views, and to demand satisfactory answers before committing or maintaining capital in any company. The ninth principle is that when a company's financial reporting raises questions you genuinely cannot answer satisfactorily, it is entirely appropriate and indeed wise to simply not invest in that company. The investment universe is large and contains many genuinely excellent opportunities. There is no sound reason to take on the additional risk of investing in a company whose financial reporting quality you have legitimate and unresolved doubts about. The 10th, and perhaps most practically important principle, is that financial reporting quality evaluation is not a single due diligence exercise conducted at the time of initial investment. It is an ongoing monitoring process that should be applied continuously throughout the entire period you hold any investment. The company that had clean financial reporting last year might be stretching its accounting this year in response to new competitive pressures or changed incentive structures. Periodic and systematic review of the financial reporting quality of every company in your portfolio is among the most valuable and most underappreciated practices in long-term investment management. With these principles firmly in mind, let us think about how everything covered in this exploration applies directly to your investment activity going forward. Whether you are an individual investor managing your own savings, a professional portfolio manager responsible for other people's capital, or someone simply trying to better understand what is happening in the businesses you have invested in. If you invest directly in individual company stocks, the most immediate and practical application is to build genuine financial statement analysis into your investment evaluation process. Before investing meaningfully in any company, spend time working through its complete financial statements with the specific focus areas we have discussed. After investing, continue to monitor these signals with each subsequent reporting period. Pay attention to changes in financial reporting quality over time, because these changes can be early indicators of business deterioration or emerging manipulation that will eventually become visible to all investors, and you want to identify them while you still have the opportunity to act. If you invest primarily through mutual funds, exchange-traded funds, or other pooled investment vehicles, your relationship to these issues is indirect but still important. In this case, your focus should appropriately be on evaluating the analytical rigor and discipline of the investment managers who are making individual security selections on your behalf. Do the investment managers you use have a systematic and documented process for evaluating earnings quality? Do they explicitly discuss their assessment of financial reporting quality in their communications to investors? Have they historically demonstrated the willingness to avoid or exit investments in companies whose financial reporting raises serious concerns, even when those companies carry exciting narratives and enthusiastic market followings? The broader and most enduring lesson of everything that Schilit's research reveals is that genuine financial understanding is among the most powerful and durable sources of competitive advantage available to any investor. Markets are composed of millions of participants with varying levels of analytical sophistication, varying incentive structures, and varying degrees of willingness to look carefully and critically at the actual financial evidence underlying investment decisions. Investors who develop the specific skills to evaluate financial reporting quality, who build systematic habits for monitoring the warning signs described throughout this exploration, and who maintain the intellectual discipline to act on what the evidence shows rather than on what they emotionally want to believe, will be substantially better positioned to build and protect wealth over time than those who rely primarily on management narratives, market momentum, and analyst recommendations. The world that Schilit describes is not a world of universal fraud and deception. The great majority of companies that participate in public markets are managed by people who are genuinely trying to build valuable businesses and who report their results honestly. But a meaningful minority of companies, at any given time, are using the flexibility inherent in accounting rules to present results that are more attractive than the underlying economic reality supports. Distinguishing between these two groups is one of the highest value activities any investor can engage in, and the framework that Schilit has developed is among the most useful and practically applicable guides to doing so. Stay genuinely curious about what you own. Maintain rigorous analytical discipline in how you evaluate financial information. Cultivate the independence of judgment to trust your analysis over market consensus when the evidence genuinely warrants it. And always remember that in the world of investing, the financial statements examined carefully and thoughtfully over time, will almost always tell you the truth about a company, even when management is working very hard to obscure it. The investors who best protect and grow their capital over the long run are not those who take no risk at all. They are those who understand deeply the nature of the risks they are accepting, who insist on receiving honest and transparent financial information as the foundation of their investment decisions, and who have developed the specific skills to detect when that information is falling short of the honesty and transparency they require. That commitment, built on the kind of careful and systematic financial analysis that Schilit has championed throughout his remarkable career, is ultimately what separates successful long-term investors from those who are perpetually surprised by corporate accounting revelations that, in hindsight, showed their warning signs long before the final reckoning arrived. The tools are now in your hands. The framework is clear. The warning signs are mapped. What you do with them from this point forward is entirely up to you.